central bank interventions, monetary excesses, rate cuts at the right time attract investors. And the problem is with that, when the Fed, for instance, there's a lot of talk right now that the Fed is going to cut in September. In fact, I think it was JP Morgan just put out a report that said they're going to cut 4 times this year. Nothing timid. I've seen some analysts predict that September will be a half-point cut. Not a quarter. Okay, so that's like, but if they just do their history, we just put out a report that's not a technical report, it's just a historical observation. We show the 2000 stock market top in the US. We show the 2007 stock market top in the US, just the price chart, nothing sophisticated. And then we show that there was a pause in rate hikes prior to them cutting rates. So there was a period after they'd been raising rates and then quit for like a year or so, especially in 2006. They quit raising rates, and we got all the way into late 2007, and they cut rates. They started cutting. 3 weeks later, the market peaked and went into bloody hell for the next couple of years. Same in 2000. 2000, there was a pause. The market flopped around. We'd call the top, but it didn't actually top. It sort of floundered sideways. Early 2001, the price action of the market started to slip a bit. January of 2001, which was actually about 6 months after the actual traded high in the S&P. Fed cut rates twice. In other words, they commenced rate cutting. If you sold that rally, it was a tombstone. In fact, our report is called Tombstone. We put a tombstone on the chart, 2001 and 2007, where the Fed started cutting rates. And right now we hear a lot of that, and that's probably what's fueling this slight move out above the early year highs in the S&P. I think that's going to fail, and when that finally fails in a way that people notice, more and more money from the average American investor, who's very lagged into gold, will suddenly say, hey, I need to find some other place to put it. And they're already starting, you can see it, the gold miners. They're starting to vastly outperform gold. And so I think these two factors are what you watch, the breakage in the bubble, stock market bubble, and the money flow out of there into the usual alternative. Usually when the stock market tops, 2000 to 2002, 2007 to 2009, there were two primary alternatives for asset managers or investors to be in: gold and T-bonds. T-bonds rose in price, dropped in yield. That has not been occurring this time. The T-bonds, they're having a little rally right now, but if you look at since late 2022, the price has gone lateral in the sewer. It collapsed in 2021, 2022, yields went up. And right now, T-bonds are all of 4 little points off their recent low. T-bond futures, I'm talking 30-year futures. So they've really not been an alternative, whereas gold has been driving north. The question is, will at some point the U.S. government debt market, which we know is in a crisis potential situation, that's the way Jamie Dimon describes it. He says this time around, it's not going to pass by. Will it, in fact, provide an alternative to a breaking stock market? And we're open to that. Although I think any rally that T-bonds do produce as an alternative will be short-lived and dangerous to participate in for the long haul. Obviously, the leader from 2009 to 2025 has been the NASDAQ 100, which is heavily tech front-ended. In fact, its top 10 stocks outweigh the entire rest of the index. And we know what those symbols are, all the big names. And the S&P has similar. It has those symbols also up front, the S&P 500, but not weighted as heavily as the NASDAQ 100. So while the S&P has gone up about tenfold since its 2009 bear low, NASDAQ 100 has gone up about 19-fold since its 2009 bear low. So we get 15 plus years and that kind of metric of growth in price. No time in U.S. stock market history, the last 100 years anyway, has that occurred. If you look at an M2 chart, or if you look at a Fed funds rate chart, you'll fully understand why it occurred. They pumped money, they had free money for 10 of those 15 years. And the money growth, which is now accelerating again, they're trying to save things, the things they think should be saved. The problem is when they get to that point in the stock market, reality takes over and you bust the bubble, the psychological bubble. It takes over. Reality wins. Policy of government doesn't win. It fuels something else like it did in 2000, 2002, 2007, and 2009. It fueled gold. It fueled T-bonds then. So I'm looking for that again. But the leader on the downside this time will also be the NASDAQ 100, the tech sector. And we all hear, the market's making new highs. Well, it is and it isn't. Small caps, Russell 2000, nowhere near its highs. In fact, if you look at the Mag 7, so-called, we're down to like Mag 3 now. It made new highs above the early 2025 highs. Apple didn't. Amazon didn't. In other words, we're losing our leadership even. Anyway, I think we're in that position now where the leadership is, if you examine internally, it's not what you think it is. And this rally, momentum-wise, from our long-term momentum analysis, not looking at price, is broken. It broke during the January through March, April break. This rally, though it's to a new marginal high, I'm talking 2, 3, 4% above the January high for the S&P and NASDAQ. In fact, if you saw the momentum chart, you would see this uptrend. It was broken in early 2025, hence the drop. And this rally on momentum is up on the underside of that structure that it broke on momentum. On price, it's nudging a new high. On momentum, it's bumping the underside of the bridge that blew up. So momentum says do not trust price. And the only thing I'm kind of looking for now is that tombstone event where they finally get what they want. They get a Fed rate cut and they know more is coming. Then that's when the shock occurs, because once that occurs, if the market starts down, that's when doubt and panic. Well, I think they'll lead. We watch NVIDIA very closely. It and Microsoft in particular right now, we're looking at as far as the leaders in the tech sector, now narrow leaders. And they will no doubt lead the downside. This doesn't mean that what they've been saying and expecting and the future might be is wrong, or that it's not going to happen. I mean, after all, at the internet bubbletop.com in 2000, the frothy talk was it's going to change your life. And you know what? It did. They were dead right. And yet the NASDAQ 100 dropped 82% in the next 2 years. 82%, while the S&P dropped 50%. So just because AI is real, has new dimensions we're perceiving, markets sometimes go too far, even though what they're chasing is true. They just go too far. They go 3 times too far, and then they exhale. And I think we'll be facing that. So I think the leadership on the downside will, in fact, be the leaders on the upside that we've seen. But some of the sectors are already exceptionally anemic, and they're pivotal sectors that nobody wants to talk about. But the banks don't look good. Commercial real estate ETFs don't look good. Too many things that are too significant to ignore don't look good. And you get me on to Bitcoin in a minute if you want to. That's an arena I think that we're predicting a major ambush anyway. Used to be, well, one, first off, it didn't really matter what Bitcoin did or didn't do 10 years ago, 5 years ago, in terms of impacting other markets. But over the last handful of years at least, especially since 2022, Bitcoin has moved almost literally month by month with the NASDAQ 100. We ran a price chart overlay a couple of weeks ago just showing Bitcoin monthly futures, NASDAQ 100 monthly. And it's almost month by month. To level off at a range like in 2024, early 2025, the Bitcoin had resistance at 110,000. It dropped down, so did NASDAQ, dropped down into April, turned from the April low, came up, made a marginal new high, got to 120,000 in Bitcoin plus. Now we're 117. But basically, Bitcoin and NASDAQ are identical. And I think now that Bitcoin has an institutional linkage where big money, I'm not talking foaming speculators, but institutions, companies have committed to crypto in such a way that it is now it's a vulnerable issue if they're wrong. And when I look at Bitcoin, long-term momentum, now you look at price is one thing. You get this up wave, a down, then you make a new high, you pull back to the last high, you hold it, you go up again. It's like a staircase. I think the recent surge over 120 was probably the last spike. And if you ever get back below 110, right now we're 117, so it's not a lot. You get back under 110,000 by much. Even the price guys should start to scratch their head, because that was a ceiling late last year and again early this year of distributors. People saying, I'm out, I'm out, I'm out, I'm out. You pierce through it, don't go back below it. That will break the pattern, price pattern. The problem with Bitcoin from our perspective is the quarterly momentum. When we measure its monthly price in relation to a 3-quarter moving average, we come up with a different visual picture of what Bitcoin looks like than what the price chart says. But momentum has a floor structure that is so bloody clear that it's used it 3 times since 2023. It keeps coming back down to the same oscillator level, namely around the zero line, which is to say it drops back to its 3-quarter average. It holds, it holds, it holds. If you go back a 4th time, you will not hold. The similar structure to this in our momentum archives is the crash in 87. The S&P had precisely the same quarterly momentum chart. It had used the quarterly structure 3 times as support. Though price was ascending, momentum was building a floor. It's the 4th time from a non-confirmed high where price made a new high in the S&P. Momentum says, you rolled over that next time. When you hit that structure, you crashed. And I can't think of a more ripe psychological market right now for a crash. And one that if it happens, and we think it's going to, the issue is at what price level, it will have wave effects. And I bet you that the NASDAQ 100 correlation to the Bitcoin chart will hold, meaning you're going to see NASDAQ 100 getting hit as well. Not necessarily a crash, but getting hit. This quarter, the numbers are seemingly far and safe enough below. 92,000, 93,000 area on the Bitcoin. If you look at a price chart of Bitcoin futures, you'll see that's only halfway back to the low we made at the last pivotal low, which was 75, 76,000. So it doesn't disturb the price chart. It blows momentum, however. But you get out, and that number is going to jump up well up above 100, probably close to 105 or something. So again, if you slip that price back below the 110,000 ceiling and break through that old ceiling, indicating this rocket liftoff wasn't a liftoff, okay? Quarterly momentum in 7 weeks is you're gonna collapse if you drop back much below into that 105,000 area. The precise number we'll calculate as we get to the end of this quarter. The point being, when we see structures like this on momentum, it's very rare indeed that they're avoided. They're there for a purpose. So that would be an ambush psychologically to almost everybody if that happened.